Good morning. Today I am going to continue the lecture, which is actually on oligopolistic market, and if, in fact, a little bit of that is left in the last lecture because we had discussed in the last lecture, especially um, the issues of limit pricing, and we have also seen some of the market forms such as king demand curve. That was actually the last lecture which we discussed about. But what I am going to teach today is roughly some other issues which is left out in the last lecture because of the time, and of course the last lecture was a bit lengthy lecture. So what I'm going to discuss today is about a limit pricing, contested market, and other aspects of oligopolistic competition. Especially, I would also like to talk a little bit on the other market forms, in fact, or other market models, in fact, deals with the oligopoly operation, basically market structure operation. So let me come to the problem, that is what is limit pricing. We have already mentioned about a limit pricing in the previous lecture and had a little bit analysis also about the limit pricing. But however, let me come to as a beginning of this lecture, let me look into some of the aspect of it. So if an existing firm has a lower average total cost than potentially new entrant, it may be able to prevent entry through limiting the price in that level of price. So a limit price is actually the lowest price at which a new firm can enter an industry and just cover average total cost. Now we have already seen that the beauty or the characteristics of oligopolistic competition is because of the economies of scale and other aspect. In fact, there is a lot of advantage for the firm in terms of product differentiation, in terms of information asymmetry between firms, etc. So these are actually the aspect, in fact, give top priority for being yourself as a oligopoly or oligopolist in that sense. So in that particular context, this need to be understood. Why? Because if I am being a firm inside the market, then I make some sort of a profit, super profit. Then naturally that will invite a new entrant, potential entrant. And in fact, limit pricing is a price which is a lower price of this particular firm, that is normally the average total cost price, and that or variable cost, whatever. Then in that sense, of course, there is also an interesting point we have to keep in mind, that when you are talking about a oligopoly firm or a monopoly firm or an imperfect firm, they never ever produce their output at a constant or an increasing cost case. All right. All these firms, that is the beauty of this kind of a market and the firm's character. But normally people never talk about that. That's an issue, in fact. So what I see is the following, that when they are at a decreasing cost case, that is when of course that actually gives them higher profit, and then they are at the decreasing cost possibility. What they do is actually they always produce at the lowest in that sense. All right, that means the price which they fix at that particular point is actually the lowest price. So that is how the lowest price comes, because every subsequent unit of output production is in fact comes up with a sort of a fallen price or fallen cost in that sense. That is actually the kind of situation in which we are. So this is what is actually normally I mean, people hardly discuss in this class basically, but in oligopoly or in monopoly, this is in fact the rule of the game, in fact. Okay, so that is why they are able to charge a lower price. Many people have always wondered that why should they produce at ATC at its minimum, because these firms never ever produce their commodity at a constant case or in the increasing cost case. This is very important, and that is why they have economies of scale. That is why they do have actually all kinds of information asymmetry led market advantages. Otherwise they won't have that market advantage. This is also we have seen right from the very first lecture on market structure, that is the perfect competitive environment onwards, because in the perfect competitive environment this possibility hardly exists. That's a problem, once you don't have this possibility of basically what you call the decreasing cost case, then naturally you produce at a constant cost, because that is what is the very perfect assumption says about the perfect competition. And of course normally we do have the downward sloping curve, U-shaped curve, and all this is in fact never exists and that perfect competitive situation, because a priori price is being fixed and you are not a price taker or a maker, and sorry, you are not a price maker, you are always at a price taker. So whatever price is given in the market, you accept it and you come inside. Okay, now if you are having a lesser price, then there is a problem that there is an issue of information asymmetry, which is never ever allows under the perfect competitive environment. This is the most important and striking difference between perfect competition with that of an imperfect competition, whereas we have already seen in the imperfect competition like monopoly, oligopoly, or in any monopolistic competition, where the problem of information asymmetry plays a crucial role, and indeed that is in fact act as the basing or baseline of making your rate of profit. So in that context, it is pretty clear that lower average total cost can be made, because this existing firm is already in a decreasing cost position, and every subsequent unit of output they produce, they can actually have a decreasing cost. Therefore what they do is actually they would be producing the maximum and fix a price at the lowest. Now that price is perhaps maybe also a constant price, but perhaps we don't know. That is, there is a possibility of that kind. So if that is the case, then what is actually the new entrant is left with? A given price. So that given price is actually being determined by the existing firm. Therefore this price is a limiting price. They cannot change the price, increase the price, because already producing firm is enjoying some sort of a profitability over all the quantity which they have been produced. So this is what is actually the logical conclusion of this particular statement, because this is very very crucial as far as the pricing behavior of the firms are concerned in that sense. So the lower ATC may results from we have already you have now IRS, then you have more efficient production including patented production methods, etc., which we'll discuss in some point later, because these are also monopoly. A patented product means what? It is a kind of exclusive selling right. In that sense, it is a kind of a monopoly. So once you have all this sort of market performance, then market interactions, then and then only you can have the sort of a higher advantage over the produce. So lower input price is also for you, maybe because of so many reasons, maybe because of geographical advantage, maybe because of other possible advantage, size, market power as a buyer, track record, political influence, or whatever. This is all people try to say. For example, we had already discussed about Galbraith's point when we talked about the monopolistic competition or the oligopoly itself, was roughly. So all this is in fact the building blocks of this ATC fixing at a low price, fixing at an ATC which is lower in the market, and of course the new entrant may perhaps if still they want to actually enter, then their economies of scale may be perhaps maybe less than the other firm, then definitely they will enter in that context. So this is what is actually the very idea of limiting price or limit price. Particularly, there are a variety of limit prices which market imposes. We will come across that in subsequent lectures also, not right now, but anyway we will discuss that also. So let me now go to the other aspect of the theory of contestable market in that sense. So recent development in industrial organization have focused on issues of entry and exit fund. Now, this is also another juncture, because the earlier lectures and market models which we discussed so far discussed, in fact, the free entry or entry and exit is perhaps easier. But that is not the case. William Baumol and others developed a theory of contestable market, offering first alternative to the ICP paradigm, in fact. So the key idea of the contestable market is the following, like the threat of quick entry by a potential competitor is enough to make an industry behave as if it were a competitor. This is the first idea. The threat of quick entry by a potential competitor is enough to make an industry behave as if it were competitive in that sense. Now, what is a contestable market in that context? Like potential entrants must be able to serve the same market as existing firms. Okay, so this is the first point. I mean, within this larger oligopoly or whatever market which we talked about, there are markets which can be contestable in that sense. So potential end, what does it mean? It means that the potential entrant must be able or must able to serve the same market as existing firms do. Okay, this is nothing to do with the new market. They are the existing market, they can occupy the existing market. New firms may use the same production technique and produce at the same per unit cost as existing firms. So this is also not possible in that context. I mean, this is all perfectly goes with the original structure which we had, in fact, formulated to see oligopoly or monopolistic competition, or even perfect competition per se, and potential entrant in a zero sunk cost in that sense. You come, but you don't actually involve much this sunk cost, or what you can, or one-time cost, which irrecoverable cost in that sense. So another point is potential entrant estimate profit based on existing industry price in that sense. So now this is just like, actually you see the market as a perfect competitive environment where you basically take the existing price and the profitability. I mean, of course, if the profitability, I mean, in the oligopoly it is also possible that you have positive profitability, but that is not the case with perfect competition, where actually the price is already been set at the constant level and we cannot change. AC, AVMC and AVC, everything is going to be one and the same in that context. So that kind of situation, then whatever you produce is actually, you can survive in the market with the additional output which you come in. So it is just like, actually a perfect oligopoly is actually envision some sort of a perfectly competitive market situation. So what is actually any example of this particular thing? I mean, of course, there are many people try to figure it out in the following way. There are instances like air industry as an example. A route served by only two carriers could result in anti-competitive behavior. Could those carriers earn positive LR, economic profit? Okay, long run economic profit. If other potential other industries are absent, or this route may be of contestable market, another carrier could transfer planes to this route if profit fails, it could transfer its plane to some other route, that is what is called the contestable market. Now, of course, this whole idea of the firm becoming monopoly, etc., is actually, again, it's a perspective in that sense. It says that there is no other fixing, or everything will be determining based on the demand and supply response. That is perfectly fine with the original understanding, but there are issues because the airline industry, the example of airline industry, or even if you talk about the railway, for example, in railway in India, you don't have a competitor, but you cannot simply say that the price is huge in that sense. No, in a railway you have it's a cheap rail basically. Indian rail is a very cheap rail service because the political intervention or the governmental intervention is about the understanding the state in that sense, and they see this as the commodity price in that sense is limited in that sense. Okay, same the case with even airlines. Of course, there are many problems involved because of so many reasons. Earlier, airlines are costly, or trains are costly. If you think, it is also part of technology in that sense. Now, every time people used to give examples that the telephones. Okay, now in the earlier times also, when telephone lines or the phone connectivity, etc., were not so technologically superior. You cannot actually, all this which right now we are experiencing is because of a technological revolution. That is not only the competitive environment, but also its monopoly of the firms. Especially when all this invention, then it is counterproductive, that kind of an argument, because when I say that patent is required for innovation, then you are trying to say that monopoly is good. But at the same time, it increases the competition. It is actually counterproductive, because if you have a monopoly, then you are a monopoly firm because of the patent. And if you, it increases what kind of competitiveness is. There are so many problems involved in that kind of an argument, which is circular argument. I don't quite often subscribe this view, but anyway, it is out of our context right now. So let me come to the contestation issue, because this is very crucial, because there are many industries which you can locate this kind of a possible contestation, where you can transfer your resources one place to another, and that transfer is basically because there is a possibility of profitability. And this profitability is nothing to do with any cost involved, like a sunk cost, which we had rightly pointed. Now, because you're already in the business of a different kind, and you just simply divert your asset or resources in this case, and then you're making use of the existing possibility in that sense. So that is actually the idea. So in that sense, they give actually a kind of pressure to the other firms also, and they try to serve the market in that sense. Now, many companies, if comes, no issue. I can actually keep on talking about a number of examples which either give positive sense as well as the negative sense. Okay, so I don't want to actually go in much detail or on all this aspect. So let me we will discuss that if some queries comes up. Okay, so now, this is also not that much important, because anyway, this is part of this thing. So when an industrial configuration is sustainable, when no firm is making economic profit, and thus there is no incentive for new entry. Now, if the above four conditions hold, then either the incumbent will hold price and profit down to deter entry. Naturally, the entry is being deterred, as the concept already discussed. or new firm will enter, ultimately drive down the price. Now, driving down the price is not going to lose, as I said in the beginning, because the monopolistic competition, sorry, when you talk about all this kind of market structure, especially oligopoly, monopoly, no firm, it's an illusion. I have seen in textbooks also, that they will be there is a possible U-shaped curve or a saucer shaped curve when production is being set at that. This is all basically makes no sense for me. I have a complete reservation being a teacher, and logically that is absurd basically for me. Why? Because the absurdity comes because of the following. Why? If I am a monopoly or I am an oligopoly market or oligopolist per se, then my profitability is already said that it is dependent on my cost. Now, if it is a constant cost, that would be the maximum I would be producing. I will never cross the constant cost case because I don't have a profit. Additional unit of output never gives me additional unit of profit. Now, whatever the second order condition for that particular context is zero, that sense. So the difference of my profitability is zero, therefore I have no incentive in that sense. So being a monopoly or oligopoly or a monopolistic competitive person, I have no such interest whatsoever for producing any commodity in that particular market structure if the profitability is actually negative. So zero is dead end, but negative is definitely being a monopoly. I'll never oligopoly. I will never go there. So my reservation is already been set by the very fact of the assumption. Then I don't have, or I either experience an upper portion of or an increasing cost of this particular industry, the characteristics in my firm. That is actually the point where I'll in fact stop the thing. So this is what is actually called the modern theory of cost. For instance, we had already discussed why the modern theory of cost is L-shaped, because this is precisely this reason that there cannot be a upper shift, because no firm, that firm is actually a counter logic of the Homo economicus. That's a problem. Homo economic or the economic man is actually a rational man. That is what is actually our assumption speaks about. So a rational man in that sense, if profit motivated rational man, never rational person never produce at a losing end, having no hope. When you are at an increasing cost case, you will never ever experience your cost going to, or you never even expect that your cost is going to fall, because it is in the third stage. You are actually producing in the stage 3, which is quite bizarre kind of a logic if you argue in that sense. But at the same time, what I do is actually I'll be always operating at the first stage or in the second stage, like constant case. That is the dead end of the story. So that is why you have an L-shaped curve. Now, if you keep this in mind, then this is also very interesting in that sense. For all the 4 assumptions makes that you don't invest much on it. Then you also get part of this kind of market and get the profit being shared. At the same time, if still you can make better, then there's a possibility we have already discussed in the previous lecture that then you become a price leader in that, because you have more advantage than the existing firm in that sense. So you may replace the existing firm as a leader of the price and all. So these are all possibilities which comes under this particular market structure. So again, as a concluding point, concentration does not always lead to anti-competitive behavior. This is what I see. Concentration we had already discussed as part of the oligopoly firm. And it doesn't mean that, or it never, not necessarily lead to anti-competitive behavior. So there are possibility that you sell at a lower price. Of course, people call it as predatory kind of price and all, but still you supply at a lower price, and potential entrant keep existing firm from restricting output and raising price. So concentration doesn't necessarily imply positive economic profit. If entry is easy, positive economic profit will attract a new entrant. Of course, as a principle, the market, there is no issue in fact. But that will basically withers the monopoly or the oligopoly power. So this is a very important point. Now, what are the possible criticism which somebody can level against? So I have already mentioned a couple of criticism. Plus, this contestable market, the theory does not apply. An incumbent builds a large factory filled with specialized capital good machines and enjoys substantial economies of scale. These machines cannot be used to produce any other goods, hence their cost is sunk. Such sunk cost may serve as a strategic, uh, loss in that sense. Okay. Now we had already discussed about the game theory of the oligopolistic firm in a different lecture. You had two lectures talked about all this aspect of game theory, but anyway I'll be touching upon the duopoly context. That would be the next lecture, because the duopoly I am going to deal with in a separate lecture, because that is the most important one. So thank you for listening this short lecture. Thank you.